Welcome to BC Tech Scaleup Academy. This video is part of our Funding and Finance curriculum and provides a May 2025 software capital market update. Our featured expert is Daniel Gardiner of KPMG, and the topics of focus include historical performance and trends, the premium on profitability, and how growth expectations have changed.
Number one, capital raising remains challenging. Minority equity raise deal activity has remained quite depressed relative to the high watermark in 2021. So just for reference, trailing 12-month activity for Q1 2025 is down about 55% versus 2021. Again, that was quite an elevated level, but if you look back over the 10-year trend, we're still about 30% below kind of the trailing 10-year average. So it's a early stage and growth equity deals are still challenging to get through. The silver lining, point two, is that the Canadian software M&A market has stayed relatively robust despite all of the negative sentiment and general, sense of uncertainty out there. The trailing 12-month Q1 deal activity for private Canadian software companies is actually above the 10-year average. So I'd say from a capital raising perspective, tough at the early stages, but there's been an influx of different types of buyers for Canadian software businesses. And so exit activity has actually remained above the 10-year average. In terms of profitability versus revenue, we always have that trade-off. We track an index of 95 publicly traded software businesses. In the current market, profitability is expected. A few years ago, there was a premium, and we talked about, shifting the boat, trading off revenue in order to get to cash flow break even or get into the black or into the green. Today, 97% of public software companies are expected to become profitable in the next 12 months. About 70% have already made that pivot. So there's still a gap of folks trying to move their business to become profitable. A few years ago, we saw a valuation premium for those companies who have become profitable. Today, that valuation premium has dissipated. It's simply an expectation that you need to either be profitable or show a very short-term path to profitability. The trade-off then is on growth. So growth expectations have dampened. Only about 30% of public software companies are expected to grow above 50% over the next 12 months, which is quite low relative to, the bullish expectations for software revenue sales over the last 2 or 3 years. And for the first time in the last, 4 years since we've been putting together this report, there's actually a public expectation that some public companies will contract. So about 10% of publicly traded software companies, Wall Street analysts are actually forecasting revenue contractions for the first time in like 4 years. So that shows that, from a sales and marketing perspective, sales cycles are longer for products, and the markets are adjusting to those expectations. Finally, the rule of 40 is really where folks kind of focus on that balanced trade-off between revenue growth and profitability. And achieving the rule of 40, although quite challenging, still will earn you a significant market premium. So if we look at our public company index, businesses that are beating the rule of 40 traded about 9 times forward revenue versus companies performing below the rule of 40 are trading about 4 times forward revenue. So almost a 200% premium for those companies, albeit fewer than in the past, who are able to achieve that rule of 40, predominantly driven by balanced growth and strong profitability.